Isabel, Lauren, can you still hear me?
Yes, I can.
Okay, perfect. We have 12 participants, but I think for time's sake, maybe we'll just get started. So good afternoon, everyone. Welcome to today's panel discussion on the key trends that have arisen as a result of the COVID-19 pandemic. My name is Deviki Mutaya, and I'll be moderating today's panel discussion. I'm a senior analyst at a London-based investment advisory firm, an Edinburgh University alumni, and I'm the GAIN Edinburgh University liaison. Joining me on today's panel is Lauren French from Ruffer and Isabel Molser from Euronext. GAIN's hosting today's event in partnership with EUTIC, the Edinburgh University Trading and Investment Club. EUTIC is one of the UK's largest student-managed investment funds, whose mission is to educate students about finance and give members real-life experience in trading stocks, providing network opportunities, and helping members to pursue their careers in financial services industry and other leading graduate recruiters. Over the next hour, we're going to discuss what it's like being back to work in the current environment, key trends in the market as a result of the pandemic, and advice from our panelists to those of you who are looking for jobs and internships in the coming year in this current environment. So during the webinar, I encourage you to share with us on the chat how it's been coming back to university or work and how you feel you've adjusted. Please also feel free to ask questions and we'll try to answer as many of them as we can, otherwise some at the end. So before we begin, just a bit more detail on GAIN. Some of you may already be familiar with us as an organization, but for those of you that are not, GAIN stands for Girls Are Investors. Our aim is to inform and inspire young women about the many highlights of investing as a career. With that, I'm very excited to invite both of our panelists to start the discussion. So, Lauren, you studied geography at Oxford University. I was wondering if you could tell us about how you got to where you are at your current role in Ruffer.
Yes, of course. Hi, good afternoon, everyone. So yeah, as Devika mentioned, I studied geography, which isn't sort of a traditional route that you might imagine you would take to enter into a career in finance. But what I really benefited from, firstly, I mean, geography is a multidisciplinary degree, and I studied the sort of geopolitical side of things and was always interested in how that influences the economy. But my interest in finance really started from some work experience that I did in the summer of when I was a student, and I worked on a trading floor at Bear Stearns, a big currency trading floor in Canary Wharf. The reason this was really significant and what made me so interested in financial markets was by the time that the next year came and I was hoping to maybe get a job, Bear Stearns didn't actually exist anymore, and it had been sold to JP Morgan for $1, because that was the height of the financial crisis. So for me, that was a really enlightening time to see what was going on. Bear Stearns being in the eye of the storm with the credit crisis and its subprime mortgage funds. But then I became more interested in what really I wanted to do in financial services, for focusing on working with clients. So again, when I sort of left university, it was quite a difficult job market, as it might well be for some of you when you're looking for jobs. And so really I was keen to just try to get any experience that I could. So I started off working at J.O. Hambro Capital Management as a sort of entry-level operations job. And that was whilst I tried to find a way to get into a more of a graduate research investment focused role. So having that sort of on my CV really helped then when I applied to Ruffer, which is a small organisation, but one where I really was interested in the graduate programme there, and the fact that I could do a mixture of research and investing and speaking to clients. So I've now been at Ruffer for nearly 10 years, and I've sort of started as a graduate, worked my way up to be an investment manager, managing portfolios for private clients. And now I'm an investment director there, looking after my own team. So sort of getting used to people management as well as managing money and clients.
Great, thank you so much, Lauren. And Isabel, you previously worked at Goldman Sachs and you also did an MBA at Cambridge. I wondered if you could tell us how your experiences have brought you to where you are today at Euronext.
Yeah, my pleasure. And hi, everyone. It's great to be here. And thanks for inviting us this afternoon. Yeah, so at the beginning of my career, I really knew I wanted to do something international. And I was really thinking about more sort of diplomacy, or I don't know, just something where I could use my language skills. And I got to travel. But then I ended up studying business. I didn't get into the chosen international courses I was trying to do. So it was business initially was kind of my second choice. But again, I thought, well, it's international. It's still, sort of within the business world. And but I wasn't really set on banking. And as you mentioned, my first job after my undergraduate studies was at Goldman's. And as soon as I'm German, as soon as they saw, okay, German speaker, after my studies in London, I went back to Frankfurt and I did, well, first I went to do an internship and then I was offered an analyst role. So really bottom of the food chain in the whole investment banking system. And I did that for a couple of years. It was a great experience. This is quite a long time ago, so I'm sure it's all changed now. But I must really say I enjoyed it. I learned a lot, but the culture at that time was still probably what you have in mind when you think of Goldman's. I'm sure it's changed dramatically, but it was really that FaceTime culture, and you had to be there because your boss was still there. And I didn't really agree with that. Even at the beginning of my career, I really thought like, oh, I'm not sure this is me. So then I was working for Reuters for a number of years, and then for me the MBA was kind of a time to think about what I really want to do. So I really went into doing the MBA with an open mind, and I thought, okay, I give myself this 1 year to figure out, why is finance still what I would like to do? Would I like to go into marketing? Is it something completely different I would like to do? But it was, I came back full circle to the financial world and have worked in asset management. After the MBA, I joined iShares, the ETF brand, well, now it's part of BlackRock, at the time, Barclays Global Investors, and sort of went through different stages there. So ETFs, then had a quick stint in consulting, back to ETFs, and now I changed from the client side, so from exchange traded funds. I was dealing with all of the exchanges to now working for an exchange and been head of business management here. So if you look at it, if you look at the different stages and sort of jobs I've done throughout my career, there's been kind of a common thread, but there's also been a bit of meandering, if you will. It wasn't, because sometimes when you say, well, how did you get there? And did you think this is what you would like to do? It's like, I didn't. And it's little steps, but I think there's sort of a common thread, yeah, which brings you where you are in the next stages.
I suppose if most of us look back to ourselves maybe 10 years ago, we might be surprised to see where we all are now.
I know, and this is what, and speaking to you guys at university, don't put yourself under so much pressure. Is, of course, you need to know kind of what you would like, or what you like and what you don't like. That's really important. But don't put yourself under pressure and say, now you need to plan out your next 10 years and where you're going to be and all that. And when you get that question in an interview, that's really nonsense. Nobody knows, especially in the current environment. And nobody had that straightforward career plan, or very few people, I would say.
Yeah, I completely agree, Isabel. And I think it's all about practical experiences. Once you start actually working somewhere, or you get some work experience, you really realize what a place is like. And I didn't know when I was sort of 20, 21, what I wanted to do at all. In fact, actually, that was one of the reasons for sort of getting a different entry level job at an organization first, was that I went off traveling for a bit first, and then decided to try to join the finance world.
Yeah, I think I resonate with that. I definitely agree. But it's hard to dodge those questions when you get them in an interview. You just have to think of the best way to answer them
Or maybe
and hope
ask
for the best.
the question back is like, well, where were you 10 years ago and how did you get here? I don't know.
Interesting interview tips everyone should take note of. Well, I think everyone can definitely agree we're living through some interesting times, both in our work-life balances and in our personal lives. Lauren, you had mentioned earlier that you came back from maternity leave in August. So how have you found coming back to the work environment after a while and all that's changed?
Yeah, it's been a very strange time for me because I went off on maternity leave in October last year, packed up my desk in London in the office, and sort of couldn't really have imagined that I would be returning to work in a world where we were not even allowed into the office when I first started back, let alone trying to set up an office in what was meant to be my son's nursery. So it's been a very strange time. Obviously, there's lots of really difficult things going on in the world, and it's an incredibly challenging environment for lots of people, and particularly I imagine everyone listening in at university is such a different experience to what you might have imagined. But for me, there have been some positives as well, you know, as a working mother trying to balance a career in investment and things like the nursery drop off, and actually working from home and flexible working becoming a bit more of the norm and more acceptable has been definitely a positive.
And Isabel, do you have any changes that you've noticed in the workplace, or does anything that Lauren was saying resonate with you? Or have you felt like it's been much of the same?
No, it's definitely changed a lot, and it's from different perspectives. And one thing I think, and this will be the one of the lasting changes. So different companies, of course, have different approaches to flexible working. A lot of firms still have the very traditional approach in terms of, no, it can't be done and we all need to be in the office. And especially me working for an exchange, we work very closely with all of the banks, all of the trading floors. And there it was just unthinkable that this could work from home and you need to sit in front of your 5 screens and have your Bloomberg and everything. And it really is true. It always, people always say like it can't be done until it can be done, because as everybody else at the beginning of the year, so come March, full lockdown, we all had to work from home and it worked. So just from a Euronext perspective, so of course we run the stock exchanges in 6 different markets. So it's Paris, Amsterdam, Brussels, Lisbon, Dublin, Norway, Oslo. They were open. It did work. The technology worked. We had just a minimal number of staff really on site and making sure that the actual trading engines are up and running. Everybody else was at home. So 98% of a company where previously, if you were asking for working from home for a day, that was sort of frowned upon. It's like, oh, she's not serious about her work. And, how can you ask for that? To all of a sudden, it works. It really does. So that was a huge change also in the culture of just our organization, but I'm sure it's the same across our industry where and this is why I mentioned previously my experience at Goldman's, where you just had to be present, you had to be in the office. And that's already been completely turned upside down. There were some attempts to bring people back into the office and back into the city, but even that is sporadic. So a lot of companies haven't done that. They told people, right, it's working, work from home. We don't want to put anybody at risk. At Euronext, we took a sort of medium approach. So our office is open. I'm actually in the office, even though this is a background. This is not our office. But so we said the office is safe. It's open. If you want to come in, great. If you don't want to come in, great. And we really have half of the team here for 1 or 2 days a week. And some people have a long commute, who have, of course, underlying health issues, childcare challenges. It's taken into account. And I think that is really, as horrible as this global pandemic is, this is one of the positive things. because that change from 5 days a week in the office to the flexibility we have at the moment would have taken decades. I hope we continue that bit minus the pandemic, but I think it's accelerated a lot, and I'm sure all of you read, in technology, what people knew we kind of have to adapt. We're on Zoom. I really have to put my hand up. I had no idea what Zoom was before March. Even Teams was this, I don't know, a bit of a tool internally I didn't want to use. It's like, how can we just get on the phone now? Of course, we spend all our time on Zoom and Teams and whichever media, so we got a lot more savvy in using those. And I even see that I have two kids as well. Even they had to adapt it very quickly and adopt technology, just get on with it. So yeah,
I definitely agree with you, Isabel. I think we just have to get on with it, and push comes to shove, most businesses have seen that we can actually work very well remotely. And as you said, it's very impressive that the exchanges work seamlessly remotely. On the point of working from home, do either of you have any tips for our viewers how to stay productive?
Still, even when you're working from home, what helped me is still kind of try and separate work and non-work. So during lockdown, when we were all at home, so the two boys, and they were trying to do their homeschool work, and my husband and myself, we were trying to work upstairs and taking turns. My new office was also my son's bedroom. So in the morning, I got up, I took a shower, and then my way to work was from our bedroom to my boy's bedroom. But in my mind, I really made that conscious, like, I'm going to work now, which is really silly. And the same in the evening. So then when I logged off, shut down the computer, and then left because I was going home from work. It was a little something that helped me not to go crazy and just be online and be at work all the time. So I think that's really important, to sort of compartmentalize your day. That, yeah.
I think
that helped me stay sane.
yeah, absolutely. And I think another thing I found is the face-to-face contact is really important. So when you're sort of talking to your team, or with the university students talking to colleagues or your lecturers, wherever possible, having your camera on to try to sort of replicate that feeling of being actually in a face-to-face meeting, because a lot of people have got quite and for right reasons, you're all in different circumstances, and as you say, some of us are in bedrooms trying to do our work, and it's natural to be sort of camera shy, but where possible, I think to have that level of kind of interaction face to face that we're missing is important, to kind of try to collaborate in that way as much as possible. And I've definitely found, the commute being so much shorter, just getting myself ready for the day in the normal way, not staying, in my rough clothes, or the motivation around that, and making sure that I do have a regular break in some way or another, because you're otherwise on the screen a lot more than you might be in the office without that kind of break to talk to a colleague at the desk or something.
Yeah, I think I agree with both of you. Having those breaks and having face-to-face is really important, as well as being able to separate yourself from work and having a personal life, just to have that work-life balance. Well, just like our work-life balance, there's been a lot of changes in the industry as well, particularly in the markets. And to move on to the main topic of discussion for today, I was wondering, maybe I'll start with you, Isabel, if you've noticed any notable trends in the markets that have come about because of the pandemic.
Yeah, and I just would like to share a couple of screenshots with the audience. Oh, no, I can't share, but that doesn't matter.
I can share them for you, don't worry.
Because what I thought I would just talk about briefly from my perspective, so very much the trading perspective, is what happened in the markets and how markets have reacted, and throughout the year, what have been the developments. And there I just pulled up a couple of graphs of the major indices. And it's been, of course, an incredible sort of journey over the last couple of years. And Devaki, if you could put up the S&P 500 one.
Yes, sorry, Isabel, we're just having a bit of a technical issue.
I'll just, we don't really need the slides. I mean, you all know that the markets over the last 5 years has been a steady incline, and the markets were going up, and then all of a sudden what we've seen in March, this big downward move. So the markets went down across the globe, volatility shot through the roof. So because there was so much uncertainty in the market, there was tons of trading. So this was one thing where all of the exchanges, again, this is not only for Euronext, we really hit the perfect storm of everybody at home. Is the technology holding up? Tons of trading, tons of liquidity, tons of volatility, and it worked. Across the globe, you didn't see one of the exchanges having to hold their trading. What you saw last week at the Tokyo exchange, where they had hardware problems. I mean, for an exchange, that's sort of your nightmare scenario. But during the crisis, during that time when the financial markets had to stay open, they all stayed open, which was one huge step to sort of reassure investors, even though, I mean, the sentiment and everything that was going on was pretty dire. It's still, there was a little bit of positivity where it's like, okay, at least this is holding up. And I don't know if you're aware, but a number of European governments then tried to put in regulation and said, well, should we still be trading? You have all these high frequency traders betting against the market, driving prices even further down. But there you really, it's, of course, I'm a big believer, and you'd say, well, you would say that, to really just let the market run, because in France, short selling was prohibited then. That really hurt the dynamics of the market rather than help it. And now I hope you can all see the screen. So here, last 5 years, the S&P 500, and you can see very clearly 2020 in March, it just all went almost vertically down. The interesting thing is that since then, so if you look at the very right-hand side of your screen, we're back up, and we're actually above the levels we were pre-crisis. And if you could jump to the second slide, please, because then I compare the S&P 500 and the NASDAQ. Here you can see the NASDAQ, which is the orange line, it's even above where we were trading pre-COVID and pre-global pandemic. And I think that's very interesting for two reasons. Well, one, okay, the NASDAQ has recovered a lot more than the rest of the market because, of course, it's tech stock heavy. So really, you've got these companies, where I said Zoom and all of the technology companies reflected in there, and all of the winners of this pandemic. Sometimes you hear, well, which companies are going to come out of this better than before? They are in the NASDAQ, and you can see that in comparison to the S&P 500, a more broader index, they have been the winners. The other thing you can quite clearly see, and this is what scares me sometimes, is the disconnect between our financial world and the real world. Because if you looked at that graph, things are going up, it's really, things are going well, and we all know that they're not. It's, what's reflected here in those prices. And I'm not normally a negative person or like one of these doomsday prophets, but there will be, I'm pretty sure, a correction. And of course, the companies, they've performed well, they have a model for the future, they will continue to do well, but some of them are not. And if you could go to slide 3, because here I have a reflection of the European indices, so the FTSE 100, the DAX in Germany, and the CAC 40 in France. And the green line is the FTSE. It's a different time frame here. It's just for the past year. And again, you see in March when it just went down, and at the bottom you see the volatility. Significant impact here. And then the recovery period since March, since the full lockdown. In the UK, unfortunately, we're the bottom green line. The middle line is the CAC 40 in Paris, and then the top line is the DAX 30 in Germany. And again, here you see different paths of recovery. And I think here, because the indices are constructed, again, in a more broader way, and I'm so sure, Lauren, you will talk a lot more about asset allocation and pockets, but what we can really see here, it does matter what the industries are that are involved. So for example, in the FTSE 100, you have a lot of leisure companies. We've just seen this week, all the cinemas are closing down, which is terrible. You have airlines, you have a lot of banking and financial services. So this is why, in comparison to when you look at the US indices, quite a different picture that is painted here. But I don't want to be too negative, because the good news is another big area, of course, for exchanges are IPOs, so initial public offerings, when companies take that big step to go public, to offer their shares to the market. And everybody was predicting, okay, it's the market is dead, there will be no IPOs. And actually, it's been quite an active market, even during the periods of March was dead and April, nobody did anything. But come May, there have been more and more companies come into the market. And again, it's very varied geographically. But for example, our Oslo Børs, which is part of the Euronext family, so the stock exchange in Norway, have seen a record year. A lot of companies have taken that step and said, no, now is the right time. We're not having crazy overvaluations. This is who we are, this is what we do, this is our plan for the future. And they had some very successful IPOs. So I'm really saying it's not all doom and gloom, but it is very selective which industries are going to come out of this in a stronger way, and which are really have to rethink their business model. And yeah, we will have to see how this all calibrates out. So this is very quickly, just from my perspective, so trading, volatility, and the IPOs.
Great, thank you so much, Isabel. That was definitely very insightful. And we'll follow up with some questions later on. But Lauren, I wanted to ask you more about asset allocation and looking at portfolios. Do you look at them differently now? Are there any specific changes in portfolios that you've made as a result of the pandemic?
Yeah, well, absolutely. It's an incredibly different environment now to the environment that we've seen over many years. If we look back through history, the falls that we saw in March were some of the worst that we've seen since 1987, let alone the financial crisis and the dot-com boom and bust. And really what one of the big trends that we saw unfold in March, in the height of the crisis, that Isabel's touched on with, panic selling, volatility increasing, was where do we go for safety, or what assets will actually provide positive performance in this type of sell-off environment. And for those of you studying economics, you're probably familiar with the idea that, as you move more up the risk curve, you get more reward the more risk that you take in a simplistic level. So equities are the asset to hold for the long term if you're happy to weather the storm and hold those through volatile environments. But when you're looking at it from a sort of multi-asset level, I think one of the stark trends in March was that there really were very few hiding places. So the traditional assets that you could rely on for protection, typically government bonds is a good example, where you'd hold them and think that in an environment where the equity market's falling, that bonds would provide an offset. And this is a crucial trend in a kind of portfolio construction theory, that you can hold a combination of equities and bonds, and your bonds, typically government bonds, will provide you with that protection in an environment with more volatility. But what we've seen this time around, and it's really as a result of an ongoing macro trend that we've seen for many years, is that lots of asset classes are now correlated and will not provide that protection. And one of the key trends around that is as a result of the central bank intervention that we've seen in markets. So since the financial crisis, what we've seen is interest rates being held low and quantitative easing, so printing money, which has effectively pumped money into the financial system and boosted real assets. But it has had the effect of basically a rising tide that's floated all boats. So in this sell-off environment in March, what we saw was bonds fell, equities fell, your traditional safe havens of gold and currencies all fell together. So it's very difficult to find something which would actually provide that offset. Now, one interesting theme there is how do you actually play volatility? How can you be the other side of it as a portfolio manager? Can you hold assets that actually will protect in a volatile environment? And that takes you into the deep and complex world of derivatives and buying protection in your portfolio. So insuring yourself against the market crash. So if you're interested, I would look up the VIX as a good index there to think about how you could actually hold that, and it would provide some offset to an environment where the rest of your portfolio is falling. So a key trend being a correlated sell-off in asset classes in March. But then fast forward to April, and Isabel touched on it, and it's completely counterintuitive. You know, headlines that we've got some of the worst job losses on record. And in the background of that, we've got some of the best days in the market since 1987. So the economic picture is very gloomy, but the markets seem to be completely ignoring that. And why is that? Well, again, it comes down to intervention and stimulus. So the Federal Reserve kept interest rates even lower at negative, announced a huge quantitative easing package, and several central banks followed. And that really had the power to introduce that stimulus back into the markets and liquidity. So with the Federal Reserve even buying corporate bonds and really propping up all different parts of the market. So we saw a very quick reversal and a big bounce. But there is absolutely a disconnect between some of the fundamentals of some of these stocks and how they're actually going to perform in an environment where the real economy is slowed down so significantly. So that's another key trend. And then outside of sort of equities and bonds, I mentioned gold. It's a very interesting asset this year because actually the gold price didn't help us in that kind of first part of the crisis. But since then, the gold price has rocketed, and some of the gold mining equities have done fantastically well. So they're definitely stocks to think of in terms of their role in a portfolio now. And one of the really interesting things there is that we're currently in a very deflationary environment in terms of the economy. But what we're seeing come through is lots of inflationary policies from the government. So fiscal response, you know, the biggest stimulus levels since wartime that we've seen. You know, the UK is spending sort of 32 billion on the furlough scheme, and Germany spending 30% of GDP on stimulus packages. All of this has helped both to boost, you know, the stock market, as I've mentioned, and to start to get consumer spending back up again. But what really the overlying picture for me there is what are the implications in terms of the economic picture? Who's going to fund all of this? Where does this money actually come from? And really, even though these are deflationary forces, it could actually involve a large inflationary stimulus coming through because of the fact that we've got large levels of debt. The government's taking more and more of the burden, and they could actually allow inflation to creep back into the system, and that could be a very different and challenging environment for asset returns, and therefore the likes of gold could be very interesting in that environment. So that was the other sort of key trend to think of this year is what is the impact of all of this stimulus, and what are the assets that could benefit from it?
Thanks, Lauren. We actually have a question from one of the participants. I think you briefly touched on this earlier, but maybe if you could just reiterate the point. So the question is from Albert. He says, how has the potential for the US stimulus deal changed market trends?
Yes, I think I touched on some of this. So the US stimulus, you know, really it's a continuation of more of the same, more of what we've been seeing. But a really interesting dynamic here is what happens next. Where can the authorities go if they've already tried all of the quantitative easing and stimulus in terms of printing money, and we're already at the zero bound in terms of interest rates? What will happen next? And something like an astonishing amount of debt currently has a negative yield. So $16 trillion of bonds are on a negative yield. What does that mean? That means that investors are happy to hold a bond for its life, accepting that it will lose the money over the duration of that bond. Now, this is a completely unprecedented time for this kind of asset, because normally you're holding bonds for that income, for that return. But the central banks are so desperate to stimulate the markets that they've effectively introduced a negative return on cash, which is causing investors to move into different asset classes. And now we even see that in the bond world. So bonds that used to provide a return just don't anymore. And in terms of sort of equity valuations, how you're trying to value an equity now using sort of a cash flow model when interest rates are so low, it leads to a very interesting difference. And the fact that growth stocks, those that benefit from this low interest rate world, can continue to thrive. There's a big valuation gap between growth stocks and tech names, as we mentioned, and sort of cyclical and value names. Isabel touched on them, you know, commodities, travel, all of these stocks that if there is actually a reversal and potentially a coronavirus vaccine, these are on a very low PE ratios and could actually really benefit in the bounce, and could be something that are very interesting. You know, the price that you pay now for those versus the price of some of these very toppy heights of the tech names, you know, that difference is a very interesting tool in equity selection.
And just to add to that, Lauren, just because also at the moment you see how this US stimulus deal is also used as a political instrument, and how that affects markets. So, and unfortunately, the markets do react to Mr. Trump's tweets and random thoughts. But even so, his threat of, well, until I'm re-elected, there's not going to be any further stimulus. You saw that immediately affecting the markets and driving them into negative territory. Just so at the moment, sometimes it's not all how we would assume the market reacts, and there's a lot of politics in the short term priced into this, and we will just have to see how this pans out. But yeah, I agree with everything Lauren said, and almost the scary thing is, how are we going to pay for all of this? We need the stimulus 100%, but then what? But we'll see.
We have another question actually from the participants. I'll put it out to both of you, just to circle back onto hedges in portfolios. The question asks, have asset managers taken into consideration buying Bitcoin as a hedge, considering it's now being known as digital gold?
Should I go first? Bitcoin's a really fascinating one. You know, you've got the real lovers and the real haters of this asset class. And I think one thing's for sure is that, you know, it's here to stay in the sense of its popularity as an investment. But really, from my perspective, it's kind of how credible is it as an actual part of a portfolio? If you compare it to something like gold, which is obviously a long-standing traditional asset class, against Bitcoin, where there are lots of uncertainties as to its credibility under the surface. But it's certainly popular, but it hasn't made its way into any of my portfolios yet.
I was looking forward to your answer, Lauren. And this is me personally. I'm very skeptical, but you're absolutely right. It's here to stay. People are interested. People are watching it. It's certainly a trading instrument, but I'm almost glad to hear it's not in any of your portfolios.
Yeah, exactly.
You can. It's absolutely an instrument where we also get a lot of questions, especially also on the ETF side. There are some markets where you can invest, or the underlying of the exchange traded funds is either just one digital currency or a number of those, and you have people really trusting and believing in that instrument and wanting to trade it. Yeah, it's, I don't know. And again, there's a different drivers and forces at play in terms of, well, could it be adopted? Could this be sort of the global currency? Well, what then with all the national currencies? Which country would be willing to give up the sovereignty of that? So it's yeah, an interesting topic, and but I agree, it's here to stay, but we don't quite yet know what to do with it, would be my assessment.
You're always looking for that sort of bubble-like characteristic, and the price of Bitcoin went up so dramatically, so quickly, almost like a sort of tulip mania type environment, where the more it was talked about, the more the price carried on going up, and then suddenly, you could have lost a third of your money in it within a matter of a month. And you did see that very aggressive spiraling back in the other direction, because who's guaranteeing this under the surface, and is it sort of just a speculative bubble, or does it have actual real value in terms of the way it could be used in the future? And for now, it feels that it's moved back into the doldrums because of that large correction that it had. But that also, you need some more credibility before you can move forward in terms of the exchange side of it and how it could actually be treated.
Thanks, both. Our next question is on ESG. I might tweak Olivia's question a little bit just to make it a bit more related to the pandemic. She would like to know the changes that have occurred over the past 5 years within your firms in terms of ESG, but maybe if you could just talk about if there's anything specifically that's changed in ESG over the last 6 or 7 months.
It seemed to have brought it more to the forefront of people's minds. And we have seen that reflected, and I'm sure, Lauren, you can give more evidence, but in terms of asset flows and investment solutions people are looking for, it's definitely moved out of the nice to have corner into more of a main stage. And because the question was, we as a company, what have we done? And there at Euronext, ESG is a very big topic. Last year, we announced our strategic pillars for the next 3 years, and in total is 6 pillars, and ESG and sustainable finance is one of them. And there's different categories, because one, it's in terms of us as a company, what do we do at Euronext, how are we behaving in terms of ESG criteria, how do we conduct our business? So there's a lot of focus internally, but then also, of course, with our clients on the listing side, and also in terms of that's equity listing, but also bond listing. There's a huge demand from the investor side, but also the issuer side for green bonds. There are discussions in the European arena in terms of even in encouraging this and making it a lot easier. So it's a lot, and we do things very strategically. We also do things on a day-to-day basis. So last week, it was the Clean Oceans Day. And so a group of us from the London office, we got our wellies on and our gloves on, and we went and cleared some rubbish from Regent's Canal here in London. So sometimes we really go down to the grassroots and say, like, right, there's stuff we can do in our community, or more on the for the S of the ESG. Here we work with schools, we do CV workshops, we give people sort of guidance in terms of career choices, and also just seeing what can we do in each of our locations, but then also very much on the level of the managing board. Okay, how do we conduct ourselves? How does that affect, for example, our listing rules? What criteria needs to be met? And finally, just one area I would like to also mention is on the index side. So creating new indices, I've shown you the break mainstream ones earlier, but there is a lot more demand now for ESG variations of those indices. So you would then have a CAC 40, but under ESG criteria. So there our colleagues in the index team have already launched quite a lot of new products, but the demand is really there. Where if you would say 5 years ago, it was more a product sell rather than a pull from the clients, but it's very high on our agenda.
Yeah, and from my side, thank you for asking the question, Olivia, because it's, you know, it's a really crucial part of investing going forward. And I think one of the really big changes is ESG has gone from being just a sort of buzzword and something people feel they have to have an answer about to a really crucial part of portfolio management. And exciting for me that, you know, at Ruffle where I work, the ESG has been taken very seriously. We now have not only pressure from our investors to have really good solutions on the investing side, be it from negative screening, actually ruling out stocks completely because of their environmental impact, be it oil and tobacco, etc., all the way through to how we act as a stakeholder and positive engagement and how we actually lobby as shareholders positive change. And I think that's a really positive step, is that not only are the investors asking us for more accountability, and we're doing a lot more there, that actually we're trying to incorporate ESG into our research framework. So alongside looking at fundamentals and valuations of a company, asking lots more ESG questions and recognizing that that has a vital influence on actually the profitability of a company going forward. So actually incorporating ESG into your research process is quite an overhaul in terms of the way that analysts might actually think about companies and how much do you weigh the ESG factors in there. But I've definitely seen a dramatic change over the last few years, and it's thanks to, you know, we manage money for the likes of charities and trustees who want answers to these questions on behalf of their stakeholders themselves as well. In terms of this year with coronavirus, I don't think that has been any particular extra impetus there this year, but definitely it's coming more and more to the forefront of everyone's minds.
Thanks, Juan. I definitely agree that ESG has gone from something as being a marketing gimmick or a buzzword to definitely being ingrained in a lot of investment managers' portfolios and trying to actually deliver on that, including it in their research process and the way they engage with the companies. And I think we could definitely have an entire discussion just on ESG and how it's impacted investing. But we're running out of time, so I just want to make sure that we get in the last bit where we give some advice and tips to the students out there who are looking for jobs or internships in this current environment, which we all agree can be quite difficult as it is. And then on top of that, you have the fact that a lot of companies are not taking internships in person or jobs at the moment. So Lauren and Isabel, any tips for our viewers?
Yes, you're absolutely right. I mean, the job market is not going to get any easier. But Lauren, you lived through a really difficult period and you know, made it work. And I think what I would say is stay flexible. Consider options outside of the more traditional ones. And what I mean by saying that is also look at companies that offer opportunities into new areas. So what I mean is really look at the fintech sector, look at these types of companies coming through with new ideas, and really changing the financial industry. There's a lot happening, kind of almost in the background. But so when you're looking at options for internships, don't just look at the usual, okay, you can look at the banks or asset managers, look at some of the other places around in the ecosystem. I would also say, if you're able to travel. Brexit's going to happen at the end of the year. So, if jobs here, or if the job market here doesn't look that great, well, maybe consider something in Zurich or in Paris or in Frankfurt. Just don't limit yourself. Like I say, if you're able to, if you have language skills, even better. But, these cities are so international. So don't think, oh, I have to speak German to go to Frankfurt, or French to Paris. Of course it helps, but it's not a complete prerequisite. So yeah, be flexible in terms of what type of role, and also geographically. And if that still doesn't work out, do something you enjoy. And because then you're going to be good at it. There are always transferable skills you can bring back to the financial world. And I think everybody, as a hiring manager, you look at the whole person. You don't just look at the academic grades and how many internships. You want somebody who fits in your team, who brings new ideas. And if I think of my own team, so one of my team members, she is a neuroscientist. And to be honest, when I first interviewed her, I felt completely inadequate. I'm like, why do you want to be in my team? Like, what can I contribute to your sort of development? But for her, she was fed up with science, fed up with academia, and she wanted a change. You can imagine, Frances, her sort of scientific brain coming into our world, it is so beneficial, because if you have too much groupthink and everybody has the same sort of, yeah, we agree, she comes up with ideas. So, again, if your dream internship at whatever organization you choose doesn't turn up, think, how can I spend a summer that I'm going to enjoy? Because then you're going to learn some skills you will be able to bring back to the industry, and they'd definitely be valued.
Yeah, I couldn't second that more. I think some of the best graduate interviews I've done has been someone giving the example of their customer service work in Tesco's and how that applied to how they've learned, to go above and beyond for a client. So I don't think you should feel that you'll be judged just based on your academics or your financial experience. I think of the things that you can do and what you're doing now that could relate, be it your experiences within a committee at university or some sort of organization. Get yourself involved in things that you could actually demonstrate passion but also transferable skills. I think that's a really, really good one. I think when it comes to the application level, I think given the competitive environment that we're in, really take time to tailor your cover letter and your CV towards the particular company. And the power of networking shouldn't be underestimated. I don't really know what's going to happen with real life career events at the moment in terms of visiting a stall at a milk round anymore, but if you can actually in your application speak about who you met, or how you've taken measures to actually get to know the company in a better way, be it you've seen on a website and listened into one of their seminars, the power of that kind of thing, and to make you stand out from the crowd in the in the interview process. I think you should definitely take that on board, and really think about the culture of a company and why you might like to work within it. And we've touched on it, but there are so many different areas within the world of finance. There are the big investment banks where you'll have lots of different graduate intake programs. And then there are the really small firms where you would be quite, specific quite early in a particular area. So think about for you which way you'd like to play it. And then, just go back to people again. And if you have the ability to talk to mentors, or using this community, the GAIN community, to grow your contacts and to ask advice, I think that's a really powerful thing, and definitely something that I benefited from when I was not sure what I wanted to do and didn't really know many people that worked in finance. It's just so great to have the kind of resources like GAIN around to help you.
Thanks, Lauren. I would definitely say that no one should be discouraged from looking for a role in investment management or finance just because they don't have a background in maths or business or even finance for that matter. Companies are always looking for fresh ideas and fresh views, and nowadays culture is very important. So it's more important what you can actually bring to the company in terms of culture and hardworking and different ideas than just the academics. Sorry, go ahead, Isabel.
Interrupting you, but just also what Lauren said in terms of the culture and what you just mentioned. Also, when you get a chance to spend time at a company or meet people within an organization, really think, of course, you want a job and you want to sell yourself, but also they have to sell the company to you. So also think about it, that person, you're going to spend a lot of time with them. And if you think, like sometimes you can get an impression pretty quickly where you think like, that works, that doesn't work. Even when you walk into a building or you sit in a lobby, I mean, now it's probably all going to be online, but even then you get a feel. Really ask yourself, is that right? Am I being sort of blinded by the fancy label and the fancy name, or is that really, could that work? And that's really important to find out as well. And there, just be honest to yourself, because it's, if that isn't right, it's not going to work in the long term. So again, I wouldn't underestimate the sort of the cultural aspect, the intangibles, the bit that you can't really measure, but you know exactly whether it would be a fit or not.
Thanks so much, Isabel and Lauren. It's been a really great discussion, and I hope the audience found it as interesting and insightful as I did. Just to wrap up, so make sure to check out GAIN's website, which is gain.uk.org, and you can find more details on our upcoming events this autumn. You can also follow us on Instagram and LinkedIn, where we share updates, inspiration, and several resources. If you want to sign up for our mailing list, make sure to contact our lovely administrator, Sophie. Her email is sophie@gain.uk.org. Finally, if you want to find out more about EUTIC, check out their website, which is eutic.org, or follow them on Instagram and Facebook. Thank you so much, Isabel and Lauren. It's been really great speaking with you both, and I hope to meet you soon.
Great, thank you both very much, and good luck to everybody at Edinburgh University.
Yes, good luck, and thank you very much for having us.
Thank you, everyone.
Bye-bye.
Bye.
Bye.